everybody. I'm Lynette Khalfani-Cox, the money coach.
And I'm Teri Ijeoma, the founder of Trade and Travel.
And this is Make It Make Sense, the show that breaks down everything you wanted to know about investing topics.
Yes, and today's topic is SPACs.
Now, what is a SPAC? It stands for Special Purpose Acquisition Company. It's a business that's formed for the sole purpose of acquiring a private, fully operating business and taking that business public. In other words, a SPAC is really just a shell company with no operations, but it lists itself on a stock exchange and then raises money in an initial public offering or IPO. Then it uses that money from the IPO to merge with a privately held firm, which then becomes a publicly traded entity. Does that all sound kind of complicated? Well, honestly, it is sort of, but there is a method to all this madness. So it helps to understand the life cycle of investing in SPACs, as well as why SPACs exist in the first place. So let's talk about the why behind SPACs first. For starters, SPACs are also called blank check companies. That's because these companies are forking over cash, lots of it, to private businesses that want to be listed on Wall Street. Now, some of you might be wondering, why would a private company go public by merging with another company, a SPAC, instead of just doing a traditional initial public offering? Well, it boils down to three things: speed, money, and regulations. By doing a SPAC deal, a private company shortcuts the typical process of doing a traditional initial public offering, where a company has a roadshow to drum up interest in the business. A roadshow to go public involves holding a series of talks with investment banks and potential investors, and that could last for many months, maybe even years. Well, none of that is necessary with a SPAC transaction. Instead, the private company just holds talks with one, maybe more interested buyers, the SPAC or SPACs that want to take it public. Once a deal is struck and an agreement is reached, everything takes a fraction of the time that traditional IPO deals take. So private firms merging with SPACs can get traded on Wall Street really fast. There's also the question of fees, and you know money matters, okay? So those advisory fees that are involved with going public through a SPAC, that kind of combination, well, those fees are way lower than all the fees that companies have to pay when they do a regular IPO. So basically the SPAC deal is kind of helping them to save money during this transaction. And maybe most important, in a SPAC deal, there's far less regulatory scrutiny on a private company. For example, with a traditional IPO, executives have to make a lot of disclosures about the financial health of their business, but that's not the case with SPACs. Also, in a traditional IPO, executives must limit what they say about the company, and they're not supposed to make any kind of forward-looking statements about, say, future revenues. Well, it's actually the opposite in the case of a SPAC combination. The officers of the company that are being acquired or merging with the SPAC, they don't face those kinds of restrictions. In fact, they can and do often make predictions about revenues way out in the future, sometimes as far as 5 years or more. And so, of course, they're doing that as a way to kind of drum up or attract investor interest. And that's part of why SPACs became all the rage in early 2021. We had a lot of big name investors launching SPACs. A number of athletes and celebrities even got into the game. They launched SPACs too. It was people like Basketball Hall of Famer Shaquille O'Neal, tennis legend Serena Williams. That's my girl. I love her so much. And even former football player Colin Kaepernick. He launched a SPAC. There's even a rap song out there saying how everybody has a SPAC in a dream. But listen, the SEC warns investors to not invest in SPACs based solely on a celebrity's involvement. So you always have to do your homework. So let's talk now about why it is that you might want to invest in SPACs and what the process is like. The first phase is the capital raising stage. Most SPAC deals are priced with their shares costing initially $10 per share. And that's a price where you can get in. Investors buying into deals at this point do so mainly based on the strength of the SPAC's management team and the terms offered. Some deals include warrants, for example. The deal's sponsors put money raised into a trust. Sometimes they might even add money to overfund the trust. So buying here in this first phase is pretty low risk if you purchase those shares at IPO and you hold them until one of two things happen. One, until shareholders vote on the proposed acquisition, or two, until there's a liquidation. Now, more on that liquidation later. But the second part that you need to know about, the second phase, is the deal seeking stage. So exactly how long this phase lasts is really never quite known, at least not exactly known right up front, but it usually doesn't stretch more than, say, 24 months or so. And that's because the SPAC is actively looking for an acquisition target, and a deal must happen within a prescribed time frame, typically 18 to 24 months. During the time that a SPAC is looking for a business to acquire, the SPAC's shares can trade above or below that initial $10 public offering price. So this is kind of a moderate risk period. Next is the announcement, or really the post-announcement stage. Once a deal is announced, it's common for shares of a SPAC to pop higher. I like that word, pop. That means you might get some money out of it, okay? But really what happens here is that the more investors like the company that's being bought, the bigger the potential rise in the SPAC's share price. So let's say you had a SPAC and you got in at $10, and if that price rises to, say, $15, well, that means a 50% return on your money. Not a bad deal. But listen, if we're honest about it, we know the market works both ways. So some investors could also hate the proposed deal too, or they might worry that the deal won't be able to be completed or consummated, as they say on Wall Street. In these instances, the share price will drop. So this is why you get some significant volatility in a SPAC's share price during this phase, mainly right after the target company is revealed. But overall, though, most SPAC shareholders do ultimately vote in favor of those proposed acquisitions. Over the past dozen years, only about 10% of SPACs have been liquidated, according to the SEC. Now, finally, there's the last phase in all of this. And I know it's a little bit complicated. That's why I said we're breaking it down. We're trying to make it make sense here. But finally, there's the de-SPACed stage. Now, this is the stage or the phase when the merger or the acquisition has actually taken place. And so the stock is no longer a SPAC. Really, at this point, it's just a regular publicly traded company like any other public entity. And this is definitely the riskiest stage of the investing life cycle for SPACs, because as with everything, there's risk and reward. You don't know what's going to happen in the marketplace.
And now let's talk about why this matters. So we just heard a lot about what is a SPAC, but now let's have a conversation about why is this important to you. So why is a special purpose acquisition company important to you? Well, if you're curious about investing in SPACs, I think there's three main benefits you should know. First, it's a big advantage that you can buy a SPAC stock for just $10 a share. That's a very low cost in today's market. Some regular stocks cost $50, $100, or even $1,000 a share or more. So with a SPAC, you have an opportunity to buy a substantial number of shares, not just partial shares, without breaking the bank. Also, a lot of people think of SPACs as democratized investing for the average retail investor. That's because when you invest in SPACs, it's kind of like being an investor who gets in on the ground floor of a company. So usually only high net worth accredited investors and a lot of insiders have a chance to get in on good early deals. Now you can too. I'm not saying you'll be on par with the hedge funds or you'll get first dibs on all kinds of new stock offerings, but SPACs do help create somewhat of a more level playing field. Finally, there's an important aspect of investing in SPACs that gives you some protection against loss. And now, we know all investing has risk. Disclaimer, Lynette and I know all investing has risk. But anything that protects your downside and manages risk is a good thing in my book. So what is this protection? You remember how Lynette mentioned the deal-seeking stage? That's when a SPAC is on the hunt and trying to find a company to acquire. Well, during that period, the units of a SPAC can be separated into common shares and warrants, and either one of those can be traded. Y'all know I like to trade, so either one of those can be traded if needed. Now, some of you might be wondering, well, what if the SPAC doesn't find a good company to buy in the deal-seeking stage time frame, anywhere from 18 to 24 months? Like, what if it doesn't find a good company? Well, in that case, the SPAC gets liquidated. But guess what happens? Investors get most, if not all, of their money back. That's because SPAC deals at this phase usually guarantee common shareholders a minimum of $10 a share. In other words, a return of their money. So that investor protection is a big peace of mind for many SPAC buyers. Again, you have to know the terms of the SPAC that you're buying. Realize also that regardless of what happens with the common shares, in the event of a liquidation, the warrants are usually worth nothing. So be careful of that. But these three factors, a low $10 price, early deal access, and an investment protection, all make SPACs worthwhile to consider.
So let's kind of give it our spin, our little 2 cents, as it were, here, to give people our opinions and our experiences in terms of dealing with SPACs. So
well, and you've invested in SPACs before, so I'm going to ask you some questions. So first, like, I know you've invested in a number of SPAC deals. Is there like one that you'd like to highlight, or a few that you'd like to highlight?
Yeah. So let's talk about whether I made money or not. Sometimes I did, sometimes I didn't. I'm holding some still. So. But yes, I actually love investing in SPACs. It's kind of fun to me. Yeah,
Okay.
It really is. I don't know if it's the hunt part of it or a little bit of the not knowing, like you're buying into a company or you're really buying into the management team and you're expecting, okay, these are experts. I stand by the investor, the investing company, the sponsors. I know that they know what they're doing in a given space, say in biotech or in electric vehicles, or in, fintech or something like that. So anyway, I buy mostly based on the management team.
Okay.
But also on certain industries that I really am kind of into. So one that I bought was Atlas, and it's called Atlas Crest Investment Corporation. Ticker symbol is ACIC. And it's really a SPAC that's already found its target company. So Atlas is slated to merge in the second quarter of 2021 with a firm called Archer.
Okay.
And Archer is an urban air mobility company. Now that sounds crazy. Urban air mobility, what is that? Some hood stuff up in here. I don't know.
Like,
Urban, what is that?
drones, like air mobility. What is this?
It's air taxis. I mean, like, all the movies we've seen, and you think that in the future there's going to be like flying air taxis. I totally believe, I already know that's coming. And in China and other places,
So
they're
you're
like,
already investing in
yes,
air taxis.
yes, I'm already there. So, but listen, I like the idea of kind of getting in on something that is kind of like, a little bit future and forward thinking, has a technology angle to it. But this company is actually a startup, but that's doing very well. So they already have, for example, a $1 billion deal, a contract with United Airlines.
Wow.
Yeah. And so they have the option for that contract to be extended to $1.5 billion. They have air taxis, basically, that can go like 150 miles an hour, that can go 60 miles. And so airline companies like United are like, let's get some of these crafts, let's develop and order some of these so that we can take people from the airport to different spots. Because you know how some airports have different regional differences. Like where I used to live, New York, New Jersey area, there's 3 airports, from LaGuardia, JFK, and Newark. So, but what if you're like, I need to get to Long Island, or I need to get to, the suburbs of New Jersey or something. So in any event, these air taxis are going to be able to hop and go for, 50, 60 miles or so. And I'm sure they're going to be charging people a pretty penny.
Oh, yeah.
So anyway, this is a SPAC that's right now trading around $10, so people can still get in there. But it's just something that, I don't know, I kind of thought it was one of the fun ones, and I'm in it,
And this wait, and just so I'm clear, because I'm also wanting to make sure I get this. We're making it make sense.
Yes.
So the goal would be you have it at $10. Eventually, it'll go to about $15, and then you would sell it, right?
So okay, here's the tricky part.
So what had
happened was, the goal isn't to just make it go to 15 or some, or just some, I know you just use that hypothetically. Yeah. But it's almost like you have to pick your spot and your entry point. And this is something that I know you'll identify with when it comes to SPAC investing, because you really have a lot of stages. As I mentioned, there's 4 stages of the SPAC life cycle. And so some people just want to get in like at the $10 when it IPOs, okay, initially, so they know the price point is going to be $10, and they're just waiting for the deal to be announced. So as soon as the deal is announced, that would be you, yeah. You'd be like, I'm trading, I'm out, yeah. I know, and I'm sitting up there, I'm going to keep these profits, I'm going to keep this in the future, You're
like, until there actually are air taxis.
Exactly, until I see some flying air taxis. So I'll tell you about one next that's a little more immediate. But so you certainly can trade and get your profits. So right after the deal is announced, and again, they have up until 18 to 24 to consummate a deal and to complete that merger, et cetera. A lot of times they don't even take that long. So it depends. Some of them, because they're being aggressive and looking for different targets to buy, a deal might be announced in a month, 3 months, 6 months.
Okay.
I think it's really common to be around 6 months, 6 to 12 months, kind of at the longest, when they actually say, here's what we're buying. Here's the company that we're buying.
I feel like if you're about to start a SPAC, you probably have something in your head already.
Absolutely. And a lot of people say they know good and well. The public thing that they say is, we don't know. We're in the industry. We're looking in all sectors. They always say that. We're like you've done your due diligence.
Before you even started this, you were like, and when I start, I'm going to buy you.
Yeah, exactly. They're doing a side little deal. They're not supposed to now. They're not supposed to work it out before. But yeah, So
maybe that would just be our SPAC. When we do
exactly.
SPAC,
when we do a SPAC,
ahead of
we're gonna
time.
know.
Right.
We won't say it publicly, but we'll follow SEC guidelines.
Right.
And,
exactly.
not that there are many for SPACs. That's one of the appeals, I suppose. But Capital Investment Corp is another one. Capital Investment Corp V or 5, CAP is their ticker symbol, and this company is merging with a real estate title company called Doma.
Okay.
And the reason I like this one is, for one, I'm also a real estate investor.
Yes.
And I know a lot of the pain points in real estate. I feel like so much of the system is antiquated and old and outdated, and it takes forever, and it's all this paperwork. And I'm like, can y'all just speed this up already?
Please.
So what happens is this SPAC is basically betting, and I'm betting along with them, that having digital offerings and services that can speed up the closing process, especially with regard to the title work, et cetera, is going to be a great thing for the mortgage industry. Okay. And I agree. Again, as somebody who has properties and has mortgages and do all of that, I'm like, please do something to make it,
Make it go faster.
Make it go faster, yeah.
Right.
So, and then another one that I have is Desktop Metal.
Okay.
So ticker symbol is DM. I actually bought this one after it was de-SPACed. I knew what the company was. So I knew it was a
scares
3D.
me. I'm like waiting. I'm like, oh goodness, what happened? Okay,
No.
go ahead.
Let me see where Desktop Metal. It's already been it's out there in the universe, right? And no, it's somebody can get in and actually make some decent money on this one. So Desktop Metal right now is trading at just under $15 a share.
Okay, and
So,
you probably got in
yeah,
around 10.
Yeah. So what? So
it worked.
Yes. Oh,
Okay.
but listen, the 3D space, I'm a big believer. So this is another thing. I tend to invest in sectors. I'll like go in and I'll buy like the top 4 or 5 names in a given industry. And this one
okay.
happened to be a SPAC in that sector. So I was interested in it, and yes, it's still doing fine. But honestly, you said, "Oh, so you make some money? Great." If I had sold earlier, because like 2 months ago, it was you're gonna kill me for this because you're gonna be like, "Girl, you should have traded it. You should have traded it." About 2 months ago, it was about $30 a share. I'm really serious. A lot of 3D stocks fell out of favor the last 2 months or so.
Wait, pause.
You're gonna say, did you not take anything off the table?
I'm gonna say that's a 200% return on your investment.
I know.
And you decided I'm gonna wait.
I'm just wait.
Until what? Jesus comes back.
Until Jesus himself. No, I will say, because I own multiple companies that are in the 3D space, like Stratasys. It's not a SPAC, but I own Stratasys. I love this company. I got in at like 16 and I sold when it was at maybe like 35 or 40.
Okay.
I still
So
own
you had
shares of
132.
Stratasys.
Okay.
Yeah. Oh, I had a significant gain with them. So I do, but some of the 3D stocks, I was like, I'm keeping it. I'm gonna wait and see what happens. And but I believe in it. Can I just tell quickly, because I know you're like, girl, you should have taken some of your profits. So in the course of this series, you guys, as we're talking about investing, you're probably gonna see that Teri gets in and out of the market. And see, this is why Teri is the multi-millionaire, 7 and 10 and 20 times over. And I'm just in that little low 7-figure category. I'm talking about, the long term. I'm talking about the long term. See, I'm old school. I got to change my mindset and kind of get with the times. But
I'm listening. I'm ready.
But okay, so overall, this is what I just wanted to say about sectors and about the 3D sector, for example, as a whole. We just came out of mostly COVID-19, the pandemic. We had a huge supply chain disruption. Mm-hmm. We had manufacturing that ground to a halt and to a standstill. People were like, oh my God, we don't even have PPE, personal protective equipment. We don't have so much of the stuff that we were ordering from China and from different countries.
Yeah.
We need to start manufacturing stuff here in the United States. Well, manufacturing here in the United States is old and broken and inefficient.
And expensive.
Yeah. For all these plants and all of these factories, etc. So there's the new wave of manufacturing, which is called additive manufacturing or 3D printing. Mm-hmm. So with traditional manufacturing.
I just saw it on Grey's Anatomy. They
you
were
did?
3D printing something.
Oh, yeah.
It was great. But go ahead.
So, no, I'm just, so I'm trying to break it down and make it make sense here. Look, with traditional manufacturing, you're making something out of something. Like, let's say this pretty shirt that you have on. They took a big old piece of fabric like that, and then they cut it out and got down to the specific parts that they wanted. Mm-hmm. Or it was a necklace or a car, and they took the steel and the sheet or the, concrete or any tool, and then they carved it out. But they started from something bigger and went down. Well, 3D printing works the opposite way. It's layering things, and it's additive. So instead of reducing it and going down, it's going up a little bit at a time with these very sophisticated printers that can make anything. So, 3D printers now can make houses, they can make cars, they can make clothes, they can make artwork. But the thing that I see it best used for is for manufacturing of parts and equipment and actual real life consumer products and things that people need. So instead of having to wait for a shipment 6 weeks away in China, you could have 3D printing where somebody is able to very quickly, like in an hour, print up, 10,000 masks if necessary.
That would be awesome.
They're doing it. Awesome. They literally are already doing it. So you have some companies that are disrupting the manufacturing category as 3D printers, because we don't have to worry about just-in-time delivery and, shipping costs from, overseas and wait time and all of that. 3D printing is the new era of manufacturing. And that's the bottom line. So anyway, and I'm not the only one who thinks so.
Moral of the story is this is why Lynnette had a 200,000% return and did not sell her stock. Because 3D printing is the future.
And because, I took some profits out of some of my 3D printing stocks, but not out of that SPAC. So, however, I hear you on that. And hey, you can teach an old dog new tricks. And did I just call myself an old dog?
Right.
Oh, okay.
Young. I don't even want to say dog. I don't know. We need a new slogan.
You're millennial. I'm Gen X, so I don't know if it counts, but whatever.
We can teach new tricks. That's the goal.
So, all right, let's move on here. Now that Teri has chastised me for not taking my profits.
You see, okay, wait. We gotta pause real quick. But do you see how passionate she was about the 3D printing? So here's the thing. Like, when you're an investor, a long-term investor, you need that kind of passion because you have to believe in it for the long term. When you're a trader, you have to be careful when you have so much loyalty to just one stock, because that loyalty will make you hold on to something past when you should be selling it. So that's kind of the difference. I hope that you guys go through this series of Make It Make Sense. You'll see that you have to also know what type of investor you are. That's and that right. will help you to really figure out your plan.
And that's a great tool in the arsenal, as an investor. And that's why Teri and I said, when we wanted to do this series, Make It Make Sense, we were like, we don't have to agree on everything. We want to show you different strategies and different points of view. But also, we want you to know the gamut, kind of like all the different options that are available to you. And honestly, I kid her all the time, and I say this, but I'm for real, like wanting to be more like Teri's strategy in terms of doing more day and or swing trading when it comes to investing, because I totally get it and I believe in it, and I've done it too, but not to the same extent to make that the majority of my investing strategy. But I totally get it, that take some profits off the table. Like Tesla, we were talking about this before.
Yes.
So again, not a SPAC, but just, I was like, okay, let me get into Tesla. And I felt like I was kind of late to the party, but I made a great, 25,000 plus in a very short amount of time investing in Tesla. I took my profits, I locked them in, and I just got out of there. So that was a trade.
She was gonna just keep it. She was like, but I don't mind losing. And I was like, no, you gotta put a stop in there. Like, if it comes down, at least you can protect yourself. And she's like, but I don't mind. I want to keep it forever. I was like, but that's not the point.
Trade, like, take your profit now, come back to it later. Know. So
and I do want to say too, like, when Lynnette says that she's thinking about doing more of like short-term trading, I also like I want to be more like you too. Like, I'm so tunnel vision and focused on trading that I don't get to see all the other things. Like, I don't know what it is to invest in a SPAC. I never tried it. Like, there's so many other things, like a NFT and all these words we hear. Like, I'm so like
non-fungible tokens.
So that's another thing. We have to do another episode.
That would be a whole nother thing. But just for those who might say, NFT, what? So a non-fungible token is a digital asset that kind of represents something in the real world, but that's virtual, that you have unique ownership of. So it's usually done for things like art or
Yeah.
sports or experiences, music, anything creative that can be kind of captured in digital format. Somebody can buy it. Somebody can exploit it as the artist and as the creator. I'm going to create an NFT. I'm trying to think of like all the content that I have and all the
Right.
stuff. I'm going to create a special moment. I'm going to show like the moment my book hit the New York Times bestseller list. I don't know, for somebody,
And now it's
anybody
worth
who was inspired,
$30,000 million.
whatever, whoever's willing to buy it, I don't care, you know. So anyway, NFTs, that's another one. But anyway.
Yeah. But coming
so-
back, I guess, how
Yes.
do people get started if they want to start SPACs?
Okay, yes. So I have some ideas about that. If you'd like to learn more about SPACs, and I hope you do, just start by reading about them online. You can check out some articles, maybe some investing newsletters. But here's the thing. Don't just buy into any kind of marketing hype or promotional hype that you come across. Of course, that's the people who want you to buy the SPAC. But I want you to read information from third-party sources, not from the SPACs or its promoters. So you can just better understand the process and what specific SPACs are all about. So it's also helpful to watch business television programs like CNBC or Bloomberg TV. They often cover SPACs. And so by tuning in there, you definitely will learn more. And finally, I think it's important to take the time to learn trading fundamentals, because that really can help you to pick the right SPAC stocks and get in and out of the trade at the best time. So Teri actually does have a great course for active investors, for those of you who are wanting to trade. It's called Trade and Travel. So if you're not a very experienced investor, I really would recommend that you check it out, because you'll get so many takeaways, like how to pick good companies, how to protect your portfolio, and how to read stock charts. And all of that can help you with your SPAC investing too.
It has been a great time talking, and I hope that we made this make sense, guys.
And with that, we're going to call it a wrap until the next session.